All right, let's jump right into this comprehensive due diligence explainer on FEMSA. We're going to be looking at exactly how they are navigating a really complex global environment while still posting incredibly resilient Q1 2026 numbers. Now, if you've been following the consumer staples and retail space in emerging markets, well, you know that balancing growth with macroeconomic headwinds is frankly no easy feat. But today, we're breaking down exactly how this absolute powerhouse is making it happen. Here is our roadmap for today. We're using a structured analyst's framework, moving logically from their core business segments straight through to financial health, valuation, dividends, and then finishing up with those all-important macro factors and debt. Section 1. FEMSA Core Business Segments. To truly understand the numbers we're about to look at, we first need to understand the real-world operations behind the ticker. You see, FEMSA isn't just some holding company that only exists on paper. They are the driving force behind consumer brands that are practically ubiquitous. We are talking about the massive OXXO convenience store chain, the rapidly growing digital financial app called Spin, and of course, they happen to be the largest franchise bottler of Coca-Cola products in the world by sales volume across Latin America. They are literally embedded in the daily lives of millions of consumers. And this updated 2026 reporting structure is great because it gives us much better visibility into those distinct operations. We now have really clear lines separating OXXO Mexico from the Americas and Mobility segments, which covers their international retail and fuel ops. We also get a clear view of their distinct Europe division, the health segment, and the Coca-Cola FEMSA bottling operations. This new breakdown is going to let us pinpoint exactly where their growth and their margin expansion is actually coming from. Moving on to Section 2. Q1 2026 Financial Health. Let's analyze the growth, margins, and the latest earnings release. What is absolutely fascinating here is the consistency. Look, in a quarter where so many consumer staples companies were genuinely struggling with inflation and consumer fatigue, FEMSA just consolidated its strength. They posted a solid 6.1% bump in total revenues and a 5.5% increase in operating income over the prior year. Plus, they managed to squeeze out a 20 basis point expansion in their gross profit margin, hitting 40.5%. That is mostly thanks to smart revenue growth management and proactive supplier negotiations. But here is the crucial takeaway. It's the contrast within their portfolio. Their different segments act as natural counterweights. Case in point, the massive momentum at OXXO Mexico, where income from operations jumped an unbelievable 20.9%, easily offset the operational income dip of 14.2% we saw over in their health division. That OXXO Mexico margin expansion, it's a textbook example of successfully leveraging scale and improving your sales mix. And speaking of leveraging scale, check out this massive growth catalyst that was sort of hidden in the earnings. 11 million. Spin by OXXO just hit 11 million active users. To put that crazy number into perspective for you, that's roughly the entire population of Belgium using their financial app. It represents a blistering 22.3% year-over-year growth rate. They are essentially taking their massive physical retail footprint and turning it into a rapidly scaling digital fintech ecosystem. It adds a completely new high-growth layer to their business mode. Meanwhile, the Coca-Cola FEMSA side of house proved it's just as tough. They pushed total sales volumes up to 998.4 million unit cases. And get this, despite a really challenging consumer environment in their core Mexican market, they went ahead and set Q1 volume records in several South American countries, most notably Brazil and Colombia. It's exactly this kind of geographic diversification that really helps stabilize their overall top line. All right, Section 3, Valuation and Key Ratios. Let's see how the market is pricing Coca-Cola FEMSA today. Taking a look at these core valuation metrics side by side using verified market data, we're seeing a price-to-earnings ratio of 16.88 and an enterprise value to EBITDA of 13.34. Now, for a dominant defensive staple that has heavily established market share, these numbers essentially suggest a company being priced pretty fairly for its reliable cash flows. It's not a deep discount, but it's also not wildly overvalued compared to historical averages. I always like to look at the PEG ratio to really ground these valuations. And here, a PEG ratio sitting at 1.29 is a great translation of, so what? It tells us that, yeah, while the stock isn't necessarily a deep value play, the market is reasonably pricing in those continued double-digit growth segments we just talked about, like OXXO Mexico and Spin. Generally speaking, a PEG near 1 indicates a fairly balanced trade-off between current price and expected earnings growth. And when we pivot to balance sheet leverage, the fundamentals here are just rock solid. We're looking at a debt-to-equity ratio of just 0.59 and a net debt to EBITDA of 1.07. They are clearly not over-leveraged. When you pair that low debt profile with a stellar return on equity of 16.55%, it screams of a highly efficient management team. They're generating fantastic returns on shareholder capital without taking on excessive balance sheet risk. Section 4, Dividends and Shareholder Returns. This covers yields, payouts, and those recent earnings beats. For the income-focused investors tuning in, let's break down exactly how this operational efficiency actually makes its way back into your pockets. The immediate takeaways are great. Coca-Cola FEMSA offers a really attractive 4.06% dividend yield, and more importantly, it's secured by a very safe 62.39% payout ratio. So they're distributing just over 60% of their earnings as dividends, which leaves plenty of room to reinvest back into the business or just serve as a cushion if there's a downturn. Plus, this all comes right on the heels of a recent earnings report where they actually beat analyst expectations by 10 cents a share. When you compare these yields directly, it paints a very reassuring picture. An underlying free cash flow yield of 4.82% and an earnings yield of 6.17% that strongly supports their ability to comfortably maintain that 4% dividend payout. As an investor, you generally want to see that cash flow yield strictly higher than the actual dividend yield, and well, FEMSA delivers exactly that. Section 5, Macro Factors and Debt. Navigating international exposure and FX risks. Look, no due diligence explainer is complete without shining a light on the risks. In FEMSA's case, we have to talk about their macroeconomic and foreign exchange exposure. It's an absolute must to visualize their international footprint here. Their debt is spread out across Mexican pesos at over 53%, US dollars at 27%, plus chunks in Brazilian reais and euros. Because they operate across Latin America and Europe, fluctuations in foreign exchange rates, especially if we see a strengthening US dollar or volatile local currencies, can directly impact their consolidated earnings when it all gets translated back to pesos. However, there is a massive mitigant to that macro risk, and it's this vital number right here, 83.5%. That is the percentage of FEMSA's total debt that is locked in at a fixed interest rate. In a global environment where interest rate volatility has been a major pain point for heavily indebted companies, FEMSA has effectively sheltered the vast majority of its debt from rapid rate spikes, locking in an average rate of around 7.2%. The CEO, Jose Antonio Fernandez Garza Laguera, honestly summed it up perfectly in their Q1 release. Management knows full well that it's a complex international macro environment out there, but they are focusing on what they can actually control, executing a leaner overhead structure, driving double-digit income growth in their key retail markets, and strategically expanding their footprint in South America. They've built this company to weather exactly this type of economic climate. So as we wrap up this explainer, here's the real question you've got to ask yourself. When you weigh the massive high-margin retail and fintech growth against the natural currency risks of operating in emerging markets, does this resilient, dividend-paying giant deserve a spot in your portfolio? Are you willing to bet on the strength of the Latin American consumer? Take a look at how it aligns with your own investment strategy, and definitely keep a close eye on that rapidly scaling SPIN user base.